It's not easy finding yield in this market. My next guest has found a very interesting way to do it by selling puts through an ETF. Kevin Rich is here to explain how he does it. Welcome, Kevin.
Hi, Greg. Nice to see you again.
All right. ALPS US Equity High Volatility Put Right ETF. The ticker is HVPW. It's a long name, but it's a pretty simple strategy, right?
Absolutely. It's much more simple than the name would imply. It's an income generating fund, basically is what it is. It generates that income by selling listed puts out of the money puts on 20 different underlying stocks every 2 months. After the 2-month period, we anticipate paying out 1.5% or a 9% annualized yield. And then we do it again. So we roll the portfolio 6 times a year.
And why is this a better way to generate yield than, say, a junk bond fund or a junk ETF, which right now they're only yielding around 6%. Your fund sounds like it's going to yield around 9% per year.
Yeah, well, that's what we anticipate. And one reason is in a junk bond fund, you have the full downside of the portfolio you invest in. On ours, we're selling puts at 15% out of the money. So at the start of each 2-month period, you have a 15% buffer or protection downside.
Now, people get scared whenever you bring in derivatives, options, they get nervous. People think they're risky. What are the risks associated with this particular ETF? For example, what happens if the stock drops out of bed and you get put the stock?
Well, actually, as far as risk, Warren Buffett, one of the most conservative investors in the world, is a big put seller. So there's a lot of people out there who are selling puts effectively, managing the risk. If you get put the stock, it's like owning the option still. So if we got to put the stock in the fund, we would just hold the stock till the end of the period, till the option expired, and sell the stock.
And how do you choose those 20 stocks in the portfolio again?
Well, we track an index. NYSE Arca owns the index, and the index basically every 2 months looks at all the listed stocks in the market, chooses those that are high capitalized, high liquidity, so we can implement the strategy effectively, and then it sorts those by
and they're large cap stocks?
The large cap stocks, yes.
All right, so it doesn't really matter what the stocks are in there. You're more doing it for the volatility and the yield, the premium that you can bring in.
That's right. The high, a lot of people look at volatility as a negative. We use volatility to our advantage, and because the higher the volatility, the more the option is worth. So when you sell that option, you get more income. And again, we sell 15% out of the money, so you're getting a lot of income, but you have that buffer of protection.
And how often do those options expire worthless, which is what you want in a strategy like this?
Yeah, well, in our fund over the last 2 months and what we saw in the last year of the index and our modeling is over 80% of the time our options expire worthless.
All right, well, good luck with the fund. Very interesting way to generate yield when it's hard to find out there. Thank you,
Greg.
Kevin Rich, and thank you for watching The Street.